WTI crude oil prices just surged over $80 a barrel. The price of oil went up another 7.8% just today. And over the past week, it's up 23.42% since the war in Iran started. And overall, energy is the best performing sector in the stock market year to date, up 25.6% overall. Oil majors like ExxonMobil are up 22% year to date and are currently trading at all-time highs. Likewise, Chevron is up 20% year to date, also trading at an all-time high. But there are some energy stocks up as much as 75% year to date. Things like Texas Pacific Land Corporation, ticker symbol TPL, a company I've covered a lot on this channel in the past. So today, as oil prices are rising and the stock prices are surging, I'm going to cover 3 types of energy stocks from completely different sides of the market. I'll give my perspective in general on the oil majors, ExxonMobil and Chevron. I'll talk about some royalty-based producers like TPL, and I'll be talking about the midstream side of the energy sector with Enterprise Product Partners, Energy Transfer, HESM Midstream, and MPLX. All of these businesses have very different prospects around this rising oil price environment, and the answer of which one you're more interested in buying entirely has to do with your time horizon. Are you trying to make a quick buck in this oil price surge, and if you think it's going to go to $100, then you have some more juice to squeeze? Or if you're less sure about high oil prices being the reality for the coming years, then I'll provide some opportunities in that case, especially if you're looking to invest long-term in energy stocks. With that said, let's roll the intro and get into this energy stock analysis.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using dividenddata.com, which is my stock research tool. Right now, we're looking at our terminal product. So if you like what you see throughout the video and want to follow along, this is all available at dividenddata.com. Plus, you get our new spreadsheet add-in, which just launched. This allows you to access all of our historic financial data directly in your spreadsheets. And right now, we have our March Madness sale where you can lock in 50% off Pro membership, which gives you both the terminal and the spreadsheet all in one bundle. You get the best version of our product at our best price we're ever going to offer. It's a 30-day money-back guarantee, so no risk in trying it out. If you want to get the sale, the link is in the description and pinned comment below. And on the Dividend Data terminal, we can type in the AI analyst something like, find me energy stocks with the best year-to-date return. I add some additional filters here, like I filtered to the US and over a $5 billion market cap. And when we screen by these stocks, you can see that Texas Pacific Land Corporation, ticker symbol TPL, it's up 75%. It has been one of the top performers in energy so far this year. And the company is now nearly trading at its all-time high in stock price. They actually had a stock split late last year. It's a 3-to-1 stock split. So this is a company that used to be a little bit harder to buy a full share of. If this was back in December, it would be trading at $1,500 a share. And this is a business that trades at a premium. Based on earnings per share over the trailing 12 months, the company's trading at a 75p ratio. On a forward-looking basis, they're trading at a 63p ratio. And that's because this is a very unique and interesting business model. They own a ton of land in the Permian Basin, and they basically lease it out to oil producers, and they get royalties on the oil and gas produced on their land. So what this means is that they have incredibly high margins. And as oil prices go up, their profitability hits 100% profit. Overall, they have 90% or higher gross margins. Historically, that used to be 100%, but they diversified their business a little bit in recent years, so it's not pure just royalties. But this thing prints money. And they continue to recruit more and more people to drill on their land. So this means the volumes produced are increasing, and that's shown by in the last quarter where oil prices were not high, they had record revenue per share in the quarter. So if we go back to a long-term environment where there's $80 or $90 price of oil, we're going to see an earnings surge at TPL. As you can see, their free cash flow per share has exploded, and really over the past decade, that's when they started actively managing this land better and actively recruiting people to drill on it. And last fiscal year, they had record free cash flow per share. Now, I hopped into Google Sheets real quick so I can give you a little more context behind the business. With our new spreadsheet add-in, you can load in key performance indicators, KPIs, and for a stock like TPL, I specifically want to dive into the oil and gas royalties revenue. And keep in mind that this royalty revenue, it's extremely high margin. It's nearly pure profit. And this starts to give you an idea of how oil prices impact their business. In 2022, that was when they had the highest oil and gas royalty revenue. And despite increasing their volumes produced on their land, it's still not nearly as high. So high oil prices means more money is made. So is it still a good buy right now? And here I'll dive into how I think about oil and gas stocks. And this pivots directly into talking about the oil majors like ExxonMobil and Chevron. The entire game with these companies is oil prices, which determines their profitability, and then the valuation that you're buying the stock at. That is if you're going to be investing long term. Now, if you're trading, this could still be an opportunity to buy TPL or ExxonMobil. But if you're looking to invest in the company long term, this is often the worst point to buy these energy stocks. As an example, if you bought TPL in the peak of 2022, when we had $100 a barrel oil, the price went down in the years following. So you have to be ready for that. Now, TPL is unique in how profitable their business model is and how they're growing volumes on their land. So you are seeing some long-term fundamental growth underneath that trend. But if we dive into an oil major like ExxonMobil or Chevron, this becomes even more obvious as they're much more mature businesses. As you can see, ExxonMobil, they peaked in their earnings per share in 2022, and they were killing it. They were making so much money then. But at that point, the ExxonMobil stock price got up to like $115 a share. And really, until 2026, it didn't move at all. And frankly, I'm surprised it didn't go down because in that time, oil prices went down and ExxonMobil, they still remained very profitable. But you have to be very careful if you're making a bet on high oil prices and if you're buying at all-time highs in valuation. Oil is a very cyclical business. And for the past couple years, all of the energy policies have been oriented towards reducing the price of oil. And we were getting to a $50 or $60 barrel, which is still profitable, but it really doesn't support this high of a valuation for companies like ExxonMobil. I like to be contrarian and buy when they're deeply out of favor, when oil prices are low, and more specifically, when that also is impacting the price of the equity. So with ExxonMobil, that kind of rarely happens because it's such a high quality business. But in 2020, the price of oil went negative. It was unprofitable for multiple quarters and the stock price completely tanked. So I used that as an opportunity to load up on ExxonMobil. So I was able to buy the company at historically high dividend yields of 8, 9, and 10%. For context, the current yield is historically low at 2.7%. So as we're looking at a lot of these energy stocks, they're actually more expensive than they've ever been. In my personal dividend portfolio, which I update on this channel frequently, I've owned ExxonMobil for a long time. But my cost per share is ridiculously low, and a lot of that's from reinvesting dividends as well. My cost on initial dollars invested is $32.47. That makes my yield on cost 10.07%, and from reinvesting dividends, that's up to 12.6%. So unless you're trying to trade the oil prices right now and you're betting on it continuing to go up, I would be more cautious, not more aggressive right now, especially if you're viewing this as a long-term investor where you're trying to buy and hold. But the energy sector, it's very interesting. There are different sides of it, and some of it, they're not as impacted by the oil prices. As an example, the midstream assets. Companies like Energy Transfer LP, HESM Midstream, MPLX, or Enterprise Product Partners. These companies have not gone up as much, and that's because their business model is actually pretty different. And in my opinion, I still think they're better long-term buys at these current prices compared to the oil producers. And I'll dive into that and explain why and provide which examples I'm personally buying. And look at this, oil prices keep going up. It just hit $81, $81.37, up 9% today. That's a huge day. So let's just add some more context around why is this going up and where are these prices going to be long-term before I get to the stocks I actually think are better long-term buys. Look at this, the price keeps going up. And the main reason has to do with the Middle East. As you know, there's currently a war in Iran. It's unknown how long that will actually last, but the primary blocker is this thing called the Strait of Hormuz. And about 20% of global energy supply, it comes through this point. And right now it is partially blocked for commercial traffic, and this definitely will have some short-term impacts on supply. But the real question, if you're investing long-term in energy stocks, it's what does this mean long-term? So I'm going to give you my thoughts on that. So 20% of oil supply comes through the Strait, but of that, Iran is only roughly 2%. And this is the country that's really under the most uncertainty. So Iran alone, even if there's tons of regime change and just disruption and they can't even function as an economy, let's say the worst case scenario, that drops to 0% and they're not able to produce any oil, which that's probably not even going to happen. In the worst case scenario, they're only 2% of the market. That gets absorbed pretty quickly. So the big thing more is just the strait being blocked. That's the bigger factor. Now, the interesting thing is, I don't know if that's actually going to last that long. Now, everything I have read personally about the U.S. strategic policy here, they have been very clear that they want to keep the strait open. They have outright said that the Strait of Hormuz is not closed and that U.S. forces will continue to defend freedom of navigation through the region. Now, I'm not sure if oil has actually stopped completely flowing through the region. It would make sense if people are taking a little bit of a break because there is a lot of bombing. The U.S. has destroyed like 11 different ships from Iran's navy. But President Trump has said that they're going to be escorting tankers through the Strait of Hormuz as soon as possible. And it's really not in U.S. interest to keep this closed, especially when their entire thing is they want energy prices to be low. So I don't think this is actually going to last that long. But that is just my personal opinion. The oil's future market, it doesn't always entirely have to do with reality either. It's a lot of speculation. As an example, it going up 8.5% today. I don't know why that was. You'd assume that's people thinking that this conflict is going to last a lot longer and the global oil supply will be disrupted, or it's just oil traders trying to make a quick buck and there's a bit of a frenzy going on. I don't know. We'll see. My strategy of investing in energy stocks, it's much more oriented towards the midstream side. And that's because I'm a believer that will be in a low energy price environment. We have been for the past couple years, but I do think overall volumes will be high. So I've been buying companies like HESM Midstream and MPLX. And I'm not actually going to do a full stock analysis video here because I'm actually planning to do updated ones on HESM and MPLX. So I'll give you 3 that I think are very good buys, even after going up year to date. I think long term, they'll still have a good compounded return. So first we have HESM Midstream, ticker symbol HESM, forward-looking dividend yield of 7.87%. And this thing is a dividend growth machine. 5-year compound annual growth rate, 11.31%. They raise their dividend payment every single quarter. And this business model is much more shielded from energy price fluctuations. Whether prices are low or high, they still make their cut. They even have contracts of minimum volume commitments, so their downside is protected. MPLX is another midstream oil and gas stock I like. Forward-looking dividend yield, 7.37%. Again, the dividend growth is fantastic here. A 9% 5-year compound annual growth rate, and this has accelerated. The 2 most recent dividend increases were 12.5% each. Another midstream energy stock that people love is Energy Transfer, LP, ticker symbol ET. That has a 7.15% forward-looking dividend yield. I personally don't like this one as much because they did have a history of a dividend cut in 2020. They weren't able to absorb that. And that's because they have a lot more debt as well compared to HESM and MPLX. And all of these actually are pretty unique, so I would analyze them in isolation. But they are raising their dividend payment every single quarter. And as a bonus, here's another midstream oil and gas stock that I've owned in the past. Enterprise Partners, ticker symbol EPD, 5.91% forward-looking dividend yield. This one has a long history of dividend growth, 5-year CAGR of 4.1%. And recently, they've been upping their cadence of dividend increases to every other quarter. So if you're a long-term investor looking at this energy price environment, I'd be cautious. A lot of these energy stocks, they're trading at all-time highs, and you might want to get in on the train, and you possibly could do a trade there. But the long-term valuations, I like to buy these companies when they're out of favor. So if you already own a lot of the oil producers, whether it's something like TPL, ExxonMobil, or Chevron, I would just hold right now. And if there was a side of the energy market I would be buying, it would be the midstream oil and gas producers who get paid for transportation and pipelines. That is a sneaky side of the energy sector that I have been loving over the past year, and I personally built up some positions there. But even there, those prices have gone up as the energy sector has gone up. If you want to use the stock research tools I've been showing throughout the video, plus a ton of other features I did not highlight, it's all available at dividenddata.com. We currently have our March Madness sale where you can get 50% off off annual membership. The link is in the description and pinned comment of the video. There's a 30-day money-back guarantee, so no risk in trying it out. Also, if you want more content, I just released a full portfolio update going over everything I've been buying in my personal Dividend Growth Stock portfolio, and it's a long deep dive. It's like a 35-minute video. And in my opinion, that was one of the ones I had the most fun recording recently, because at a certain point, I started just talking about it like I was talking to myself. And I was basically documenting my thought process of how I've been investing recently. So that video will be linked on the end screen. And if you want to support the channel, take advantage of the sale on our software tool. With that said, I'll see you in the next video.